Imagine waking up one morning to discover that a financial system you trusted completely had suddenly become uncertain. Your savings account still exists, your job may still be there, and daily life appears normal at first glance, yet confidence begins to disappear. Neighbors become cautious. Businesses delay decisions. Spending slows. Conversations change. What once felt permanent suddenly feels fragile. This was the reality faced by millions during the Great Depression, one of the most important financial events in modern history. And while today's economy is very different, the psychological lessons remain remarkably relevant. When people think about the Great Depression, they often focus on stock market crashes, bank failures, and unemployment statistics. Those events were certainly significant, but beneath the headlines was something even more powerful, a massive shift in human behavior. The Depression was not only an economic event, it was also a psychological event. Fear altered decision-making on a national scale, creating feedback loops that amplified existing problems. Before the crisis fully unfolded, many Americans believed prosperity would continue indefinitely. The 1920s had been a decade of optimism, innovation, and expanding financial participation. Stock ownership became increasingly popular, and many people viewed rising asset prices as evidence that the future would naturally be better than the past. This confidence encouraged risk-taking, leverage, and assumptions that recent trends would continue. Behavioral economists today recognize this tendency as recency bias, the habit of projecting recent experiences into the future. Human beings naturally assume that what has been happening lately will probably keep happening. During periods of growth, this creates optimism. During downturns, it creates pessimism. Both can distort judgment. When financial conditions deteriorated, confidence reversed. Consumers reduced spending. Businesses reduced hiring. Investors sold assets. Banks faced pressure. Each individual action may have seemed rational in isolation, yet collectively, these actions deepened economic weakness. The system became trapped in a cycle where fear produced behaviors that generated more fear. This dynamic remains relevant because financial markets are ultimately collections of human decisions. Prices move because people make choices. Economies expand because individuals and businesses take risks, invest capital, and spend money. Psychology is not separate from economics, it is embedded within it. One of the most important lessons for modern investors is understanding the difference between price and value. During periods of panic, asset prices can fall dramatically. Yet the productive capacity of businesses, technologies, and economies may not decline at the same rate. Fear often causes investors to focus on immediate losses rather than long-term fundamentals. History repeatedly demonstrates that emotional reactions frequently become strongest near periods of maximum uncertainty. This does not mean every decline is an opportunity or that risks should be ignored. Rather, it highlights the importance of distinguishing between temporary market sentiment and long-term economic value. Another lesson involves liquidity. During the Great Depression, access to cash became critically important. Individuals who had reserves often possessed greater flexibility than those operating with no margin for error. This principle applies today regardless of income level. Financial resilience is not simply about maximizing returns. It is also about maintaining the ability to navigate uncertainty. Many people imagine wealth as a number, but history suggests wealth is better understood as a combination of assets, adaptability, time horizons, and behavioral stability. Someone with substantial assets but poor decision-making can experience severe financial setbacks. Conversely, someone with modest assets and strong financial habits may steadily improve their position over decades. The mathematics of long-term investing reinforces this idea. Wealth accumulation rarely appears dramatic in the beginning. Compounding often feels invisible until enough time has passed for growth to become noticeable. This creates a psychological challenge because humans are naturally drawn toward immediate feedback. We prefer visible progress, yet many important financial outcomes emerge slowly. The Great Depression also illustrates the danger of confusing economic cycles with permanent conditions. Every generation experiences periods that feel unprecedented while they are happening. Economic contractions, market corrections, inflationary episodes, technological disruptions, and policy changes can create enormous uncertainty. Yet history shows that economies continuously evolve rather than remain frozen. This perspective does not eliminate risk. Instead, it encourages a broader view of time. Investors who focus exclusively on short-term fluctuations often experience more emotional volatility than those who understand longer historical patterns. Context can reduce panic because it places current events within a larger framework. Another overlooked lesson concerns diversification. Concentrated exposure to a single asset, employer, industry, or economic assumption can create vulnerabilities that remain hidden during good times. Diversification is often criticized because it can appear less exciting than concentrated bets, yet its purpose is not excitement. Its purpose is resilience. The Depression reminds us that uncertainty is not an exception within financial systems. Uncertainty is a permanent feature of them. No forecast is perfect. No model captures every variable. No investor possesses complete information. Successful long-term decision-making often depends less on predicting specific outcomes and more on building systems that can withstand multiple possibilities. There is also a profound identity lesson embedded within economic history. Many people unconsciously connect their self-worth to financial outcomes. During periods of prosperity, this connection may feel harmless. During downturns, it can become psychologically damaging. Market values fluctuate. Economic conditions change. Personal worth should not be measured solely by temporary financial metrics. The investors who often navigate uncertainty most effectively are not necessarily those with the highest intelligence or the most sophisticated predictions. They are frequently the individuals who maintain emotional discipline when circumstances become uncomfortable. They recognize that fear and optimism are both powerful forces capable of distorting perception. Looking back at the Great Depression from a modern perspective, it is tempting to focus on what people should have done differently. Yet the more useful exercise is recognizing how similar human psychology remains today. Technology has changed. Markets have evolved. Information travels faster than ever before. Human behavior, however, continues to follow familiar patterns. When confidence rises, people often assume stability will continue indefinitely. When confidence falls, they often assume difficulties will never end. History suggests neither assumption is reliable. Economic systems move through cycles. Investor sentiment changes. Opportunities and risks coexist. Perhaps the most valuable lesson is that wealth is not merely a destination measured by account balances. Wealth is also the capacity to remain rational when uncertainty increases, to think beyond immediate emotions, and to make decisions that align with long-term objectives rather than short-term impulses. The Great Depression remains one of history's most powerful reminders that financial outcomes are shaped not only by economic conditions, but also by human behavior. Understanding that relationship may not eliminate uncertainty, but it can help investors approach the future with greater perspective, greater discipline, and a deeper appreciation for the psychological foundations of wealth.